and welcome to this episode of Governance Dialogues, a program that I'm hosting on a periodic basis to discuss important governance developments. My name is Alissa Kole, and I'm the Managing Director of Governance Center, which is a think tank and advisory firm working with corporate and public sector leaders on advancing strategy and governance priorities in an innovative way. And today we're here to discuss a new topic, one we have not yet addressed in governance dialogues, and that is the rise of passive investment, and in particular the role of index providers. And we think this is a critical topic, including from the perspective of corporate governance. We used to talk in the last 5 or so years about the dominance of the big four. And as we all know, unfortunately, that is back in the pages of the financial press, notably with the role of Ernst & Young in the unfolding Wirecard scandal. But what we're also seeing is a greater discussion around the role of the big three, and that is BlackRock, Vanguard, and State Street, which are the world's largest institutional investors today and largely passive investors. At the same time, what we're also witnessing, including in early months of 2020, is a number of redemptions from active investors such as Franklin Templeton, Invesco, and many others. So this debate around passive versus active investment is clearly here to stay. For now, the shift of assets is certainly towards passive investors, and greater questions are being asked about their interest and indeed their capacity to engage on governance questions, with greater stewardship responsibilities being placed on them, not only in developed markets, but essentially all over the world. So we believe this is a critical topic to address, including with the current backdrop, and that is, of course, the performance of equities versus debt. I think about 2 days ago, in the latest Financial Times estimates, only 3% of corporate debt is yielding a return of higher than 5%. And clearly, equities will be, for months and perhaps even years to come, a key focus of investors from a yield perspective, and therefore for us from a governance perspective. How well are stewardship responsibility of institutional investors being executed today in this world of passive investment? And with that, I couldn't think of a better person to invite to today's dialogue than Craig Lazzara, who's joining us from S&P Dow Jones S&P Dow Jones Indices. Craig is the global head of the index investment strategy, and I've had the pleasure to know him for a number of years. Craig, welcome to Governance Dialogues.
Alissa, thank you for having me. I'm delighted to be with you.
Thank you so much for making the time, joining us directly. You're joining now from New York, or you're
from Stamford, Connecticut, so suburban New York. I have to say, it's a weird feeling. I have not set foot in New York City for 4 months, which is unheard of for me. But
I think it's a miracle we can talk about investment strategies from our homes. But I think it's a topic that clearly is on the radar screen of a number of people, and we're delighted that you can join us today. You've held a number of roles, of course, not only at S&P, but also in other houses such as Abacus Analytics and other financial sector players. So you have really a fantastic perspective on what's unfolding and what we're currently seeing also post-COVID in the financial markets. And I would like to start, if we may, with the first question around sort of on the macro level, on the role of index providers in selecting markets for developed or emerging market status, and ask you, what role does governance and governance considerations play in the way that you allocate specific capital markets to these different indices, which ultimately, of course, as we all know, dictates the flow of institutional investor money to these markets? The floor is yours.
Okay, thank you, Alissa. Let me distinguish first, because I think this is important to keep in mind, the distinction. You'd mentioned the big three index providers, BlackRock, Vanguard, State Street. We as index providers don't offer any financial products at all. So the way the system works, if you will, is that people like us, index providers, put together an index. In our case, obviously the most famous is the S&P 500. Index provider or fund providers like the three you mentioned prominently, then license our indices and use them to issue financial product, be that a mutual fund, ETF, separately managed account, and so forth. So those decisions are, those roles are separate, and important to keep that in mind. Coming back to your question, the role of governance, it does play a role, but when you think about the distinction between developed and emerging markets, the most important things have to do with the scale of the economies, GDP per capita, the nature of the integration of given economy into the world economy. So is governance a factor? Yes. Is it the dominant factor? I would say no.
Okay. Well, that's interesting. So you think that essentially, from a perspective of institutional investors, the responsibility lies essentially on them as to how they oversee sort of governance of individual companies, and how do they factor in country-specific governance risks of when they select which markets to invest in.
I think the roles have to be distinguished in the following sense. I mean, the role of an index at the most basic level is to represent the world as it exists. So, for example, we have an index called the S&P Broad Market Index. Basically, it's every company in the world with a market capitalization. I think the limit now is $100 million or more, float market capitalization of 100 million or more. If you exist, you can be in the index. There's no representation that membership in that index or other indices like it means anything other than that the company exists and is of a sufficient size and scale to warrant being included in the index. When you come to an index like, say, the S&P 500, which we mentioned a moment ago, there, the index is not just everything that exists in the United States, or even the 500 largest companies in the United States, but there are also a number of other criteria that apply. So in the case of the S&P 500, for example, this is all, by the way, laid out in a methodology document, which anyone can download from our website. There's a target size that we keep in mind for new inclusions. A company has to have recorded at least the last 4 quarters of profit to be profitable. There are some limitations on a company's ability to offer non-voting shares. Now, that's a new thing that we only imposed in 2017. So the distinction, there is a distinction to be made between some indices which just aim to show everything that's there, and others which are selected for particular purposes. And the ones that are selected tend to be, like S&P 500, classic example, the ones with where there is a tremendous amount of capital tracking it, where there are a number of vehicles providing liquidity, mutual funds, ETFs, futures, options, separate accounts, and so forth. And so there's more attention paid, I'd say, in those cases. But the distinction is that way.
That actually, there's a point that you raised around non-voting shares, and I would like to come back to you with a specific example of a company that has solicited enormous attention, and that is Snapchat, when they issued essentially non-voting stock, basically for the first time in history. And my personal take was that it was a little bit of a watershed moment if you think philosophically about the future of capitalism and what that does it mean when shareholders are essentially purchasing or acquiring non-voting shares. And in this particular case, what was very interesting is that the pressure was not necessarily on proxy advisors, was not necessarily on index, was not necessarily institutional investors, but it was actually on you, that is the index providers, to exclude Snap from the index. What is your view as to kind of, in terms of the division of responsibilities for in the governance world, what is your view as to where your responsibilities should stop and the responsibilities of institutional investors or asset managers or others in the financial value chain should kick in when it comes to dual class shares, non-voting shares, other mechanisms that potentially negatively affect the rights of shareholders.
Yeah, I was going to say the word you're looking for are make governance irrelevant, but that's too harsh, probably.
Exactly.
I think the SNAP case is an application of the principles I tried to lay out a moment ago. In other words, we made a decision. I'll tell you a bit about how it gets made, but in the case of the S&P 500 and other of our U.S. indices, there is an index committee which decides admissions and deletions and changes in methodology and things of that nature. It is as much as we can make it a non-commercial entity, it is that. I mean, it's literally when we're back in the office, if we ever are, they sit behind a wall to which the door of which I do not have key to. So they are as much as possible insulated from people like me and other people who deal with clients and might have a commercial interest. Their goal is to make sure the index runs as well as it can in view of the methodology that's been articulated. Now, very often when there are potential changes in methodology, we don't just make them in a vacuum, or the index committee doesn't make them in a vacuum. The committee makes them after some degree of consultation with institutional investors, and that was certainly the case in the SNAP case, or the rule that was promulgated after the SNAP case came to our attention. There was a consultation with institutional investors, and the consensus view was that participation in governance was one of the key benefits that a stockholder should expect to have. Not just the ability to receive dividends and sell your stock if you want to, but actual participation in governance. And so the decision was made in 2017 that thenceforth companies with dual class shares, where there was prejudicial voting rights or no voting rights, and those shares would not be eligible for inclusion in the S&P 500, or for that matter, mid-cap 400, small-cap 600, any of those so-called flagship U.S. indices. Now, remember I said a moment ago, one of the functions of an index is just to show you the world as it exists. And there are people who are perfectly happy to buy non-voting stock. It exists. And so in our broad market index, global broad market index, our U.S. total market index, the non-voting SNAP shares are still there. So if an investor takes the view, I want to own that stock, I don't care if I don't get to participate in governance. There's a way for them to do that. But we thought, at least from the standpoint of our flagship indices, we wanted to say, governance, or the ability to participate in governance. Let me phrase it that way. I think that's probably the more accurate way.
Right.
The ability to participate in governance is an important part of what shareholders should expect to have.
Well, that's certainly music to my ears. I tend to agree with you on the idea of the idea that non-voting shares are problematic from perspective of governance. We already have a number of companies with dual class shares where effectively the majority shareholder, whether we talk about Amazon or many other companies, they have a deciding vote. And that is manifested in the outcomes of the shareholder assembly meetings when for example, Amazon employees had proposed some resolutions. Jeff Bezos was able to basically override them single-handedly. So it's certainly an interesting development, or an interesting area to focus in, and it seems that an area where you are increasingly having a voice. I would like to ask a question specifically around ESG indices, because you've spoken quite a bit around sort of the standard or the most known indices that, such as the S&P 500, but you also have some specialized indices that specifically create a methodology that singles out companies with positive ESG, environmental, social, governance behaviors, in a way potentially, let's say, simplifying in some way the homework, if we say so, for our large institutional investors in terms of their own approach and selective investments. What is your sort of some of the lessons learned looking at these indices? How popular are they becoming? To what extent are they being used? And do you think that institutional investors are essentially relying on them, on these products with due process on their side, excessively? What is your view on these indices particular, and how performing they've been, and what is their role in the markets going forward?
Alissa, that is the one thing I will say that is unambiguous in response to your question is that we are seeing tremendous interest in ESG, environmental social governance, tremendous interest in ESG. We're a number of providers are listing new ETFs based on our indices. We see asset flows coming in. It's not just us. I mean, our competitors as well see the same. So unambiguously, there's lots of interest. Now come the ambiguities. One of them is, to what degree does an investor want, or is an investor willing to take tracking error versus a non-ESG index? I'll give you an example. We have an index launched a little more than a year ago called S&P 500 ESG. A number of ETFs, good asset growth, good interest. The way in which that index works is that it excludes certain industries, so tobacco, cluster bombs, things like that, the usual suspects, I would say, excludes certain industries. Then it uses a set of ESG ratings, which come from a company that we've since acquired called Sustainable Asset Management, based in Switzerland. And those ratings are based on what's called a corporate sustainability assessment, a questionnaire that's filled out every year. So it's fairly comprehensive, and companies are rated on their sensitivity to ESG factors. Now, those factors can vary in importance. I mean, you might think, for example, that an industrial company with lots of factories, the E part of ESG would be much more important than it is for a bank or a real estate company. Whereas in some areas, the G may be more important, and that's customized by sector, by industry. That said, what we then do for this particular index is to take the 75% within each industry, 75% of the capitalization with the highest ESG score. So we throw out the 25% with worse scores, but there are no sector tilts relative to the S&P 500. And the resulting portfolio has 320 stocks, something like that at the moment, 320. The effect of that is to give you a portfolio which definitely is tilted toward what anyone would agree are ESG factors, but without taking very much tracking error with respect to the S&P 500. And a lot of clients like that approach. Now, another approach would say, and there are clients who do this as well, say that the S&P 500 ESG isn't sufficiently aggressive. It still holds, for example, if energy companies are 4% of the S&P 500, it's still got 4% in energy companies. So maybe somebody doesn't want anything in energy companies. And that's perfectly okay. There are other indices for that purpose. So the problem, the first ambiguity, I think, arises because clients have varying degrees to which they want to be aggressive with respect to ESG or not.
Of course. And you're highlighting a fundamental point there, and that is the subjectivity in the decision-making of institutional investors. But I'd like to perhaps ask a little bit more of probing or controversial questions around the political dynamics that you see unfolding today in markets. So, for example, when you talk about indices, you certainly are aware that President Trump had ordered essentially one large domestic investor pension fund not to invest in the indices that they were basically tracking, but to avoid specifically Chinese issuers. And there's an increasing debate in the context of the political tensions between US and China as to how funding will be directed in the capital markets. And it essentially equals to some sort of, at least it seems for now, politicization of capital markets and potentially the indices, because if investors are not just tracking these indices as they wish to be, but are being told to follow certain certain directions, that effectively changes the rules of the game. What is your take on that?
The particular controversy that you mentioned has to do with what's called the federal TSP, Thrift Savings Program. Correct. It is a program for federal government employees, employees of the United States government. It is a defined contribution plan, so they get to choose where they allocate their money. And the particular controversy came because in one of the international option that's offered in the TSP, the trustees had decided to shift from one particular index to another. And both of these indices are offered by our competitors, so I can't claim firsthand knowledge of either one. But the burden of it was that the index to which they wanted to shift had much higher exposure in China than the index from which they were coming. And the Trump appointed trustees, because the president gets to appoint the trustees of the TSP, the Trump appointees basically nixed it and said, no, we're going to stick with the index we have. Which, by the way, still has a representation in China. It's not like you're out of China if you're in the TSP far, but you do have less. I think I would say it with respect to your question. Politicization is not especially a threat to index providers so much as it is to investors. I mean, if you take the view that the trustees of TSP genuinely believed that Index B was better than Index A, it's not the index provider who's disadvantaged, it's the investors in TSP who can't go into B. Now they can go elsewhere, of course. They don't have to, all their money may not be in TSP. So it's more a problem for investors and product offerers than it is for us.
Yeah. I agree, and I think it's interesting also another aspect, and I would like to maybe close with this one last question, if I may, around government intervention and the choosing of indices and whatnot. I mean, you've played index providers, or the industry has played a critical role when the Chinese A-class shares were admitted to the largest indices where a lot of capital is flowing. But I think, and in markets like China, and we explored that in previous episodes of this program, there are also concerns around transparency, around government intervention, and of course around the high government ownership in a number of companies. And we know in a number of markets, whether we look at China, whether we look at Middle East, whether we look at some Eastern European markets, government ownership has always been quite high, and that has been a particular characteristics of this market. But what is interesting, I think, and if I may, in the post-COVID world, is that governments are also taking greater participation in a number of companies, airlines, and utilities, and many other previously privately held concerns. And that ultimately is also, in our perspective, and we've been writing quite a bit on this, changing the nature of capital markets and making them much more heavily state-owned. And my last question to you is perhaps on your views of the implications from your perspective as an index provider, but more generally on the capital market landscape. What does it mean for the future of equity markets, where state ownership is going to be, as it looks to be currently, growing for the months, if not years to come?
It depends, is the answer. I mean, you started out by asking about China, and when you were framing your question, I was thinking of something I remember a wise man telling me many years ago, which is that indices just capture the nature of whatever they're designed. Good indices capture the nature of whatever they're designed to capture. If you have a market like the U.S. Or Europe, for example, where most shareholders expect to participate in governance and do so, if you index that market, you will have an index fund that participates in governance, as we've said. If you have a market like China, where the government basically calls all the shots, regardless of what the shareholders want, when you index China, you will get an index where the government basically calls all the shots. So the index itself, or an index funds based on them, will reflect the nature of the political environment. There is, I guess, two things to say in addition. One is that index funds or indices and now index funds over the course of the past 20 years have all adopted a weighting methodology called float weighting. In other words, we only put into the index shares that are actually available for investors to trade. And in fact, we were the first at the S&P Broad Market Index was the first to do that going back to 1990. So in the days, for example, when the German government owned 80% of Deutsche Telekom, only 20% was in our indices. So if we begin to see movements of that sort, where governments begin to acquire bigger stakes, that would absolutely affect the way in which float weighting adjustments are taken, and you may see downgrades in the weighting of, or not downgrades in the weight, diminishing weightings of companies where there are big government blocks. So that's clearly a point of index instruction. The other thing to say, and again, I hate to keep saying it depends, but it does depend. When the government takes a stake in anything, when a government takes a stake, is it taking it explicitly for the purpose of saying, look, we know we want an airline industry 5 years from, assuming there's a vaccine coming, right? Well, 5 years from now, everything will be back more or less to normal, and we want to have an airline industry, so we have to take some ownership stake. Otherwise, they'll all go bankrupt and there'll be no planes flying. That's very different because the implication there is that over time that stake will be sold. As many in the U.S. case, certainly many stakes that were taken in the financial crisis have been sold down profitably, amazingly enough. As opposed to someone who says, I want to own, 30% of a particular company because I want that company to be my national champion, and I'm going to participate actively participate in governance, not only as a member of the board of directors, but also by crafting legislation and regulation to favor this company. Different story altogether. And so as governments will have to decide where on that continuum they want to fall.
Right. Now that's very interesting, and it's a topic that here in Europe, the European Commission is focusing and following very closely around competition between state-owned enterprises in particular sectors, and we're also writing on that quite a bit. So that is perhaps a good topic for one of our future governance dialogues. But for the purpose of our time today, as I said, we would like to keep this to manageable half-an-hour format. I would like to really thank you for your insights in terms of the development of the industry, where you see trends in the industry, but also in the broader capital markets going. And we hope to have you join in future occasions of this program.
Thank you. I would be delighted to do that, and I hope the next time we see each other, we really see each other.
Yes, it might be through a different format other than Zoom, but certainly for the purpose of today, there was a really fascinating conversation. Thank you again. And for our audience today, I would like to suggest that if you're interested to explore further thinking around passive investments, the role of index funds, index providers, and institutional investors, we invite you to have a look at some of our resources available on the Govern website at www.govern.center, but also some of the recent thinking and reflection from the S&P side, in particular two publications which are, I believe, available online, one called The Slings and Errors of Passive Fortune, and the other one called Shooting the Messenger. So with that subtle sense of humor, I think I will end today's program, and thank you all very much for tuning to this episode of Governance Dialogues in conversation with Craig Lazzara. Thank you.